Modern financial markets do not move in minutes or hours. They execute in microseconds. Millions of institutional orders process in a fraction of a second, creating a continuous, high-speed stream of raw numerical data. To make sense of this chaos, retail traders and professionals alike default to a single, ubiquitous tool. This diagram shows the anatomy of an OHLC bar. It condenses raw data into a fixed time interval by recording 4 specific data points. A vertical line tracks the total price range, while horizontal pegs mark the opening price, the highest peak, the lowest valley, and finally, the closing price. The critical component here is the right closing peg. This final marker only locks into place when the countdown for that specific interval reaches 0. Once time expires, the bar permanently completes. By definition, this makes the completed OHLC bar a historical ledger. It does not tell you what the market is doing right now. It only documents what has already happened over a closed period of time. If you base your live execution decisions on a ledger that waits for time to expire, you ensure a structural lag. You are reacting to past data, while institutional order flow has moved to the next pricing level. A common dogma among traders is the idea of bar confirmation. They are taught that waiting for the mathematical certainty of a closing print is the mark of a disciplined, conservative operator. That logic breaks down entirely during high-torque market expansions. When volatility spikes, price travels massive distances up or down long before the arbitrary time interval actually ends. Think of a high-velocity breakdown. Institutional capital aggressively clears out the order book, pulling price down the structural slope immediately and capturing the premium pricing. Looking at this diagram of a rapidly dropping OHLC bar, you see the active price reach an absolute low point. But if you wait for the closing peg, the market will often snap back up, leaving a massive vertical gap between the bottom of the move and where the bar actually prints its close. That vertical gap translates directly into structural drag. By entering at the delayed close, your entry price degrades, and you are forced to place a much wider stop loss to accommodate the increased distance to the actual bottom. Waiting for a closed bar degrades your capital efficiency. The mathematical certainty costs you premium pricing and heavily skews your risk-to-reward ratio against your favor. To eliminate this latency, we have to look past the discrete time steps of the OHLC bar. We require a method for tracking real-time kinetic market energy continuously, independent of when a clock strikes 0. This synchronization of continuous wave logic and discrete price bars creates 2 distinct execution models. The first is the aggressive vector, built for operators demanding maximum premium entry pricing. The entire tactical objective here is to completely front-run the right closing peg of the OHLC bar. Here is the primary structural trigger. The uncompleted price line sweeps down, intersecting a pre-calculated structural floor boundary. Simultaneously, while the downward bar is still printing, internal velocity registers maximum exhaustion and hooks sharply higher. This is your trigger. You execute the order intra-bar, buying near the dead bottom while the interval still ticks. Because entry is so precise, your stop loss is hard-coded exactly 1 tick below the uncompleted bar's lowest point. Executing before the close carries specific mathematical risks. Without the validation of institutional supply absorption, you accept a higher frequency of stop-outs if the structural floor ultimately fails to hold the momentum. The aggressive vector trades mathematical validation for pure pricing efficiency. If the wave holds, you secure your position at the absolute structural bottom before the rest of the market even processes the reversal. The alternative execution model is the conservative matrix. This is built for operators who require verified structural alignment from both the momentum wave and the static price ledger. Think of this approach as demanding uncompromising structural safety. You prioritize mathematical validation over capturing the absolute bottom of the move. Unlike the aggressive vector, here you ignore the intra-bar sweep. You let the vertical price line hit the structural wave level, and you deliberately wait for the interval timer to reach 0. Here is the validation trigger. The bar completes, its right peg printing cleanly above a core wave level like the daily equilibrium. The entry activates only on the subsequent bar's opening peg. The stop loss is placed safely behind the entire validated swing structure. This model introduces inherent structural drag. You deliberately enter late, which requires wider stop parameters and reduces your overall capital efficiency. The conservative matrix accepts inferior entry pricing as the cost of doing business. By waiting for dual validation, you drastically reduce the statistical probability of getting trapped in a false breakout. There is no universally superior execution model. Professional operators evaluate live market parameters to choose between these two approaches dynamically. This table is the strategy execution matrix. It aligns specific timing triggers and risk profiles of the aggressive and conservative models side by side. The operational choice always comes down to the tactical trade-off. You allocate risk to purchase either pricing efficiency or mathematical validation. When volatility is redlining and the data feed is erratic, the conservative bar close entry is the correct tool. The intentional delay filters out the noise and protects your capital from violent, false breakdowns. Conversely, when price hits a historically respected level and internal velocity shows clear, immediate exhaustion, the aggressive wave entry is optimal. It captures the premium pricing available precisely at the point of maximum structural tension. Superior execution requires abandoning static trading rules. It is an active, calculated alignment with the continuous parameters of the live data grid. Allowing an arbitrary time interval to dictate your execution guarantees you will operate in the past. If you rely solely on a standard historical ledger, you systematically lag the market. To eliminate that lag, you overlay discrete price logic with continuous kinetic telemetry. Before initiating any order, you must know your precise execution vector and define your stop-loss parameter down to the single tick. Operational mastery requires fluid synchronization with the environment. You adapt your timing strictly to the velocity and structural boundaries actively presenting themselves. A true operational edge does not come from waiting for the past to confirm itself. It is secured by mapping the internal velocity of the exact present moment.